Back to this special show. If you ask a lot of people why do they want to make a lot of money, I think many will tell you that it's financial freedom. Money gives us financial freedom. We can work for ourselves, we don't have to report to anybody, and we can be masters of our own destiny. I guess investing in stock markets is a way to finding that freedom, making a lot of money which gives you that financial freedom. On the show today, we are talking to someone who's done that. BasantMaheshwari is a private investor, which means he doesn't manage public money. He manages his own money. And he is also, by the way, an author and a teacher. He's written a book called The Thoughtful Investor. He's with me here right now to talk about how he did it and to kind of give us a construct of what to look for to be able to do it. Basant, thanks very much for your time. Great to have you here.
Thank you for having me.
I guess people want to know, how did you start? I mean, I guess a lot of people who want to get to where you are or get to that point where they have enough money and are able to manage their investments and have that freedom, want to get just started. Just tell us a little bit about your journey.
I started like everybody starts the stock market. I started by losing money. So when I was in college, the Harshad Mehta Pied Piper game was in full stroke. So I started by borrowing and investing from my grandmother and things like that. First 8, 9, 10 years, I had no clue of what I am doing. I used to buy stocks, trading at low P's, in double digits preferably, and nearer to the 52-week lows. This is what you exactly don't want to do in the market. But it took me almost a decade to understand what I'm doing.
Did you have some background knowledge about the stock markets or some family history in the market?
My maternal uncle were in the stock markets, but they were brokers. And information today is very much more available than it was 2 decades back.
Right.
So coming back to this, since it was a part-time activity for me, we were into a family business, and after my father passed away, our family business blew up and we had to relocate back. I had no work and no money.
You're based out of Kolkata now?
Kolkata.
Right.
Right. So that family business went off, and I had nothing to do. But internally, I always had a sense that maybe the stock market is the only place where I can make a large amount of money, because there was no capital to put up front. In the market, you can buy a steel company for as low as 5,000 rupees and as high as whatever you have. Yeah, I can go and buy Tata Steel and become an owner of Tata Steel. So that was the only concept which attracted me. I started teaching because I wanted to earn some money to actually have bread and breakfast every day. So that was it. And
so you had a full-time job, and this was a part-time activity.
It was 50-50 kind of. I never used to teach during market hours. My teaching was in the first half and in the second half. I never traded, but still I wanted to see the market just to get a sense. And that's what I do even now. But that is how it all started. We started teaching. And at that time, several things happened. It's a game of chance as well. But the chances have to be taken. You cannot leave it as a game of chance. So that is what happened. The best thing that happened was the WTC broke down. I mean, it's not the best thing, but from the stock market point, and the entire market collapsed. We had lost lots of insurance policies. I thought I couldn't pay the premium, so what do I do with that? We surrendered the policy and the checks arrived only in the week that the WTC Twin Towers were down. So got a sense to invest, bought a lot of beaten down names, SSIs and those kind of companies. They tripled and quadrupled in next 3, 4, 5
This is 2001?
2001.
2001.
So before that I was losing money. Even at this point, I have no clue what's happening. I just wanted to buy this stock because SSI has fallen from high 4 digits to low 3 digits. So that was again the strategy. Then somehow, somewhere, I got a sense that somebody told Warren Buffett we knew, but we never knew what to think about him, what to read about him. But as the internet exploded, you had an avalanche of information before you. It started, that time you had the dial-up thing, so you had to just dial it up and connect it. But that is how it started. It gave you a sense that you can make 100 times, you can make 200 times. So
who were your gurus? Who did you look up to?
It's a mix of things. I invest based on fundamentals. But when it comes to looking for stocks, I think Peter Lynch is the boss out there. When it comes to looking at businesses, how to evaluate the strength of a business, Warren Buffett is the god. When it comes to building positions and buying at the highs, Jesse Livermore. He's not talked about so much. He's a trader. But Livermore's things can apply as much to an investor. He says keep buying if the stock is going up.
And I think the famous book came out in the 20s, early 20s. Right?
It's valid even today. You can, I read it every 2.5 years. It gives you a very good sense.
Very good sense.
You cannot relate to the stocks they are written there, but it gives you a basic sense. Never average your loser. Always increase position.
So you would describe yourself as an investor. You're not a trader.
No, I'm not.
I
don't trade at all.
You're an investor.
Yeah.
Right. What's your style? How do you How do you pick stocks?
Styles have changed. As on today, basic style is I want to be invested into a sector first where there is a tailwind. So buying a mediocre company with a good sector tailwind is better than buying an excellent company with huge sector headwinds. So first is the macro of that sector, not the macro of the economy, has to be conducive. Then I try and look for the sector leader, who's the number one guy out there, because it's tough to lose money buying a sector leader. You don't lose money buying Infosys, you get a capital back. You don't lose money buying ACC, you get a capital back. It takes 10-12 years. L&T is the only...
It's actually quite interesting because on the last show we had Kenneth Andrade from IDFC, and he said that he tries to buy stocks which are actually making money in a sector which is otherwise bleeding, losing money. Now, your style is different. That's the only reason I'm pointing out, right? You're saying pick a sector where the tailwind is with the sector, and then you try and pick a good stock there. I mean, it doesn't have to be the leader, could be somewhere in between, but that will do well.
I think it's easier to move up if you're on an escalator, then you keep walking with your feet. So if there is a sector tailwind, the companies do well, and the stock market recognition also happens faster. Because P ratios expand only for companies where there is a sector tailwind. Because dreams are built around them. Ultimately, dreams go wrong also. But for valuations to go up, there has to be a sector tailwind. You cannot... I mean, there are ways to make money in turnarounds also. And that is why different opinions make a market. If everybody thought the same, there would have been no market.
Absolutely.
So there are different ways of making money. Just the things which has helped us make money, we think this is the better way for us. So if something has worked for someone, something else has worked for someone,
absolutely.
Everything can work there.
I want to get to how you get to stocks. How do you hear about these stocks that you buy? And we'll talk about a few names in a bit from now. But how do you... I mean, you've been in the market a fair bit. You have people that you talk to and trust, and I guess that's a big source as well. But you run screens. I mean, how do you hear about these stocks?
No, the only time I ran a screener was in 2009 March. I was searching for 30 percent ROE companies at 5 PE, giving you a 5% yield. And I got a lot of names where doubled and tripled in 3 months. Thermax was one of them. Voltam Transformers was there. Blue Star was there. That was the only brief period of my history where I ran a screener. It was so scared of what had happened in 2008 and 9, I was fully invested all the time. I'm never into cash. I'm always invested. So I wanted to buy 5% yield stocks at 30% ROE. ROE told you that the business is good, and the PE ratio was at 5. So 5% yield PE and at 30% ROE, it doesn't happen too often.
Absolutely.
But apart from that, I don't use screeners.
So how do you get to these stocks?
I don't need a new idea every year. Maybe one idea in 2 years.
But how do you get to that one idea? More often than not, how do you get to it?
I mean, the current setup page, like we did the show with NDTV last time. I was wearing jockey for the last 15 years. Never noticed it till 2009. So it just came to me because now buy what you see concept propounded by Peter Lynch.
Yes. It's not there anymore, actually, in a way. Or is it there? I mean, it still works. It worked in terms of pages, you're telling us. But
it will work and it will not. You have to buy it the first moment you see it. You cannot buy it after 20 years. But for Page, the company had not gone public, and it went public in 2007. So by 2009, in any case, the markets were down. So you could get into it.
You had that opportunity. If you discover the same thing now, it would be too late to do it.
No, like you could say, we always use Colgate products, but you can't buy Colgate as a stock and assume to make 100 times in 10 years again. Like Jubilant Foodworks, pizza company. Of course, now they have their problems, but at 200, 250 rupees when it got listed, I didn't buy it for another reason. But from 250, it was a very smooth ride to 1250 in 2 years. We were all buying pizzas from Domino's, but that's how it, the first time you see it, that's how it happens.
To be sure, you're not, I'll only buy a company which I can, the products of which I can touch and feel. You're not saying that. This is just an example, right?
There are different ways of the company coming to you. And this is one way. But here the advantage is, as a small first-time investor, a normal guy out there, he can get a sense of the product. He can get a sense that the company is for real. It's not a fake company. India, the basic problem is we don't know which companies are for real and which companies are for fake. Profits are the second step, but first the company has to be real. So if you're looking at the product, if you're satisfied with the product, then more or less things are for real. So that is how it is.